Hello everyone, and I welcome you back to a new session of this channel. Our today's topic is related to investment decision or capital budgeting decision and the techniques related to capital budgeting decisions. In this lecture we are going to study the traditional methods of capital budgeting, which is payback period and accounting rate of return. The modern methods will be studied in the next lecture. As earlier we said, investment decision is related to allocation of capital on long-term assets that would yield benefits in the future, not right now. And those assets could be like machinery, like building, or it could be plant, or it may be other long-term assets. The first traditional method is payback period. And what is payback period? It is defined as the number of years required to recover the original cash investment. It means how many years it would take to receive our initial investment. For example, the required payback period is 3 years and the initial investment is $80,000. We have invested in a machinery which costs us $80,000 and we have to recover it back in 3 years. Here we see the project, and this is the years and this is the cash flows in these years. In the first year we received $30,000, in second year we received $40,000, and in third year we received $50,000. Now we investigate that is the project profitable for us or not. Here we go. We summarize this by adding each year's income. 30,000 plus 40,000 will become $70,000. Here we need more 10,000. We are in need of $10,000 to complete the project's initial investment. So we add this 10,000 because the third year income is $50,000. We don't need $50,000. Here what we do, we take this extra 10,000 which we need to complete this 80,000 initial investment. After getting that, we divide it into 50,000. We take this 10,000 from this 50,000 and our third year income is 50,000. After dividing these particulars, the result would be 0.2. It means 2 extra months. The first 2 years obviously that is needy, plus 0.2 years of the third year. So we take that 0.2 plus adding to 2 years of our first and second year, and the required payback period will show us that we need 2.2 years for this project to recover our initial investment. Suppose in comparison to this project, we have another project which gives us the payback period of 2.1 years. So if we compare this 2.1 year with 2.2 year, we take the minimum years required for that project. So this project would be much more profitable because we recover our money in 2 years and 1 month. But in here we recover in 2 years and 2 months. Or suppose we have another project which takes 3 years. Complete 3 years. This is project C. This was project B. In comparison with project A, we will select project B because it would take us 2 years and 1 month rather than 2 years and 2 months. But in here in project C, the scenario is something else. In here it would take 3 years. So here what we do, will we accept this project or this project? And this is obvious that we should go for this project because the 2.2 years is much less than 3 years, and we will reject this project. The second traditional method of capital budgeting is accounting rate of return, or we can call it as average rate of return, and it measures the profitability of an investment by using information taken from financial statements. So it has precise information, as financial statements are very much accurate, and it looks for average return for a project to see if it meets the target return or not. And this is the formula for accounting rate of return, and this is by dividing the average net income to average investment. Here, how we find the average net income and average investment? We find the average net income by dividing the profit during those years to number of years. And how we find the average investment? By subtracting the salvage value from initial cost or investment cost, then dividing it into 2 plus salvage value. And what is salvage value? This is nothing but the remaining value of an asset after expiry of its life expectancy. Here you can see in this example. In this example, we are having the cost of 2 projects with us. One is the X project, one is the Y project. The initial cost for the project is $40,000 and for Y project is $60,000. The estimated life for recovering our initial investment is 5 years, and for project Y is also 5 years. The salvage value, as I said, this is the extra amount we receive after the expiry of that asset. So this is 3,000 and for Y is also 3,000. Then here we have the estimated yearly income after tax. The first year we are having 3,000 income from X project and 10,000 from Y project, and continuously going on for 2 projects we are having these types of incomes. Now here, for analyzing both projects, we have to find the average profit and average investment for each project, for project X and for project Y as well. As we said in the formula, for project X we take yearly incomes. In 1 year we were having 3,000, another year 4,000, 7,000, 6,000, 8,000, and there were 5 years, complete 5 years, dividing by 5 years. So the answer is $5,600. And the investment for project X is 40,000, as we see here, minus 3,000 as salvage value. The salvage value was 3,000, and divided by 2, as we saw in the formula. Then again we plus it with $3,000, and the result would be $21,500. Subsequently, for project B, we are having the profit for those years as 10,000, 8,000, 2,000, 6,000, 5,000. These are the profits dividing by the number of years. We are having again 5 years for this project, so dividing by 5, the result would be $6,200. And the average investment for project Y is, initial cost is 60,000, here also 60,000, minus 3,000 salvage value divided by 2, plus 3,000. This is again the salvage value, and the result would be 31,500. After finding the average profit and average investment for each project, for X and also for Y, then we divide them. The average profit would be this average profit for X project divided by average investment. So here we did the same. So 5,600 divided by 21,500 multiplied by 100, because we have to receive the percentage, and the percentage would be 26.5%. And for the project Y, we do the same. 6,200 divided by 31,500. 6,200 divided by 31,500 multiplied by 100, and the percentage would be 19.68%. And here we see that the profit is higher. The accounting rate of return, the average rate of return is higher. It has 26.0.5%, and here we are having only 19.68%. So by this method, by this technique of capital budgeting, we know that the X project is much more profitable, and we prefer this X project. At last, I hope you have enjoyed from this video, and if yes, do not forget to like and subscribe the channel. I see you in next video.